Good afternoon. I'm here with Oliver SCHUMANN, who is the Senior Managing Director for co-investments at Capital Dynamics, which is a German firm. Good afternoon, Oliver.
Welcome.
How are you today?
Thank you.
Can you introduce yourself and your firm briefly?
Sure, absolutely. Oliver SCHUMANN from Capital Dynamics. We are a global private asset manager. We have 12 offices around the world, 150 people. We manage around 14 billion, and we're focused on clean energy and private equity. In private equity, we do primaries, so fund investments, secondaries, and direct investments. Personally, I've been at Capital Dynamics for 16 years now. So I joined in 2007, and I have actually two roles at Capital Dynamics. I'm chairing the Global Private Equity Investment Committee on the one hand, but I'm also responsible for the direct investments in Europe.
So you have a very good view on what's going on in private equity in general. What would you say are the big themes for 24? You sharing the optimism we're seeing here?
Look, it's been a very tricky period the last couple of years. We've seen macroeconomic changes, we've seen geopolitical changes, we've seen technological disruption in the industry, so it's certainly been tricky. On the other hand, if I look at our portfolio companies right now, and in the direct investment team we have over 50 portfolio companies, the companies have been holding up extremely well throughout that period. So it's a little bit twofold. If you look at the operative level, I would say private equity has performed very well, and we're seeing this now fund investments, we're seeing this now direct investments. When you look at the asset class overall, it's a little bit more difficult. Investors, of course, expect returns before they commit to new funds. Now, 23, particularly in Europe, has been a very difficult period. Now, there's not been exit activities. The gap between sellers' expectations and buyers' expectations has been pretty high. I think it's narrowing right now, but it's certainly not quite there, and we're seeing sort of lower activity than we wanted. But overall, I think PE is always optimistic. PE is always looking forward. PE is trying to benefit from change. And so I'm very optimistic. And I think 24, we will see a bit of a turnaround.
And in co-investments, how attractive are they? And are you seeing any big picture trends there?
Yeah, I think on the co-investment side, we have one big advantage. We can play on a global field. Our program is really directed to play in the United States, in Europe, and in Asia. And in 23, we've seen that the US has been a better market, to be honest, more liquid market than in Europe. In Europe, the exit activity has been tricky because of the energy crisis. Price expectations weren't necessarily what sellers wanted to pay. US has been performing quite well. In our personal fund, we've seen a lot of distributions in the US, so that was a little bit an outlier compared to the market, I would say. But generally, I would say private equity is now returning in Europe. Certainly in my team on the European side, we have a huge amount of deal flow suddenly. We have 4 or 5 situations we work on very actively. That may be a bit of sort of work that we did actually in 23 and a part of carryover, but we're very happy with deal flow and we think it's going to be a good year.
So you have insight into valuations. Where are they going? Are they coming back? Are they stagnating?
It's a good question. Look, I get from every GP that valuations have come down and it's now much more attractive. But to be very honest, if I look at what we see in the market, I still see a sort of 2 trends. If you have an asset that's performing well and delivering the revenue and growth CAGRs that you really want, and the cash flows, of course, and the strategic positioning, you still have to pay pretty high prices. We call that a full price, and we shouldn't fool ourselves. It's not a price where you will make a return based on leverage. Now, if you have issues in your portfolio, you can see very easily that those prices, actually you have to get pretty big discounts to be able to sell your business. So I would argue it hasn't really changed fundamentally. I think it's adjusted somewhat to the current environment, but I wouldn't say anything that we've seen is particularly attractive or a steal. You need to work hard to achieve your returns.
And in terms of sectors, some people have mentioned healthcare is strong, industrial is strong, consumer less so. I mean, are you seeing any hot sectors?
Yeah, we try in the first place, what our strategy is to have a global mid-market diversified portfolio. So we're trying to play in enterprise value sort of below 500 million. We can go up to 1 billion, but it needs to be an interesting niche, an interesting size, a stable company, growth potential, but not too large fundamentally. And I think in that segment, we've certainly seen a lot of good transactions in the consumer sector, interestingly, in the discretionary spend. We've seen several in tech-enabled businesses profiting really from digitalization trends. I think there have been some very good transactions there. But we've also seen good transactions in healthcare, where individually, if you can play US, Europe, including Eastern Europe and Asia, you do find those markets where you have an opportunity right now of building a larger market position. So fundamentally, we try to be not to be focused too much on one industry or one sector, because any sector in this volatile environment could be hit by some things you didn't expect. And we don't want too much of our portfolio to be exposed to that. But we've seen very good transactions, also business services, some even industrial opportunities. We had one company in the US, which is much more industrial. It's within 18 months already valued at 1.8 times MOIC. So we have seen some very good deals across the sectors. I wouldn't put out one sort of over the other, I have to say.
Talking about the 1.8, how, what is your magic sauce for making that happen?
The magic source in terms of value creation, I would say, is first of all that we have to rely on fantastic lead investors. I think that's the first key we're really seeing, because they provide the local know-how that we need per country and per sector. So it's not that we as Capital Dynamics in our co-investment program are doing all that. It's the lead investors who do the work. There's no doubt about that. But I think the magic source is you need sort of mid-teens growth rates in the current environment. You're buying for what is mostly a full price, but you have an opportunity. If private equity has access to capital, which they have, and know-how, you can outperform the markets. Mid-market companies without that kind of support system and that know-how system struggle with all the different elements of supply chain issues, higher interest rates, inflationary environment, consumer digitalization. There's so many things. And I think private equity is just set up very well to benefit from these things. So when they can consolidate markets, do a lot of add-on transactions, bring in new managers, you can create those values that we're looking for. The funds we're talking to are still all looking for 2 times net multiples and 20% net IRRs. And that's what we're seeing in our portfolio. So I think it's possible. It's ultimately just hard work. It's ultimately identifying the right assets, not making big mistakes on the entry level, to be honest, and then working hard, finding your add-ons and trying to make it happen. And I think that's what we see.
You seem to have a very good plan, so I wish you lots of luck and success. Thank you, Oliver, for this.
Thank you very much for having us here.